Joining us right now for more on the markets and the impact of rising bond yields is John Mowrey. He is CIO and Senior Portfolio Manager at NFJ Investment Group. And John, we've been kind of hyper-focused on the 10-year lately, watching that as it touched just above 5% yesterday for the first time. You think we're paying attention to the wrong thing, though. It's not really the 10-year we should be watching, but the 2-year. Why is that?
A little bit. Good to see you, Becky, again. Everyone's very focused on the 10-year, and not to say that we are focused on that, but the 2-year bond led the Fed on the way up. It was well ahead of the Fed in terms of pointing to higher rates. I think the 2-year is going to be the signal for when investors get some relief. If you go back to 2000, which I think is more applicable to look at for a lot of reasons, strong dollar, higher interest rates, the NASDAQ was up a lot relative to other indexes. There's lots of reasons I think 2000 is applicable. When you looked at that period, the 2-year bond started to come under a little bit of pressure before the Fed cut. That 2-year bond started to trail off in the middle of 2000. What's fascinating about that is even though the S&P was down at the end of 2000, what was up was small cap value, mid cap value, banks, real estate, utilities, all those things that got relief from those lower rates. So I think the 2-year bond is something investors are not paying enough attention to. As that moves lower, and it should move lower, we expect to see relief in those areas.
But you also expect to see relief from the Fed cutting rates? Is that an indicator of that?
Well, I think the Fed is doing the best with the information that they have. There's a lot of knowns and a lot of unknowns. The knowns are we have 2 wars going on. We have high oil prices, some of the fastest rate hikes in history, quantitative tightening. The Richmond Fed came out and said, quantitative tightening is something we simply can't model because we've only had one observation. So you have a lot of tightening in the system. What I would say is that if you go back again to that 2000 period, which again I think is applicable, the Fed raised rates 100 basis points in 2000. They raised 3 times, okay? In 2001, in January, they cut twice by 100 basis points. So they reversed out all of what they did in 2000 just in 1 month. So things can change very quickly. And I think that even though the Fed has every intention of keeping rates higher for longer, they may be faced with a different set of events. And I know you guys were talking about this earlier this morning. Things can change quickly. I'm healthy right now, but I could get a cold and have to go to the doctor next month. Things can change. So I think investors should be focused on where the valuation opportunities are available. And we're seeing significant dislocations, Becky, in many of these areas. And I think they're completely being overlooked. You've got small cap value, for example, trading at the steepest discount to the S&P since COVID and March of 2000. Nobody wants to step into these areas because they're worried about all the reasons that I just mentioned. But the dislocations are material. If the macro environment changes, there's going to be an enormous amount of money that's going to flow into these areas, in our opinion.
So small business, if you're looking at the Russell 2000, that's been under a lot of pressure. Part of that is because of higher rates. That impacts the smaller businesses first. But if you're right that things are going to come down, in terms of the economy and beyond, if we're talking about a recession, that could hurt the small businesses pretty dramatically, too.
Well, it most certainly could. But again, I would go back to some of these other periods when you had already very discounted and recession priced in. Again, in 2000, we did, enter into that recession in 01. But what did very well were those areas that were already attractively priced. So I think that valuations are what investors should be focused on, even if a recession is possible. It's very possible we get a recession because the yield curve's been inverted, and historically, when you get that, you do get a recession. We've seen it unwinding. It's been unwinding from 100 basis points of inversion now to around 20 basis points, and the markets are down. The 2000 value's down around 11% the last 3 months. The mid-cap value's down around 11% as well. So we have seen some weakness in those areas for sure as that has been unwinding. But again, going back to some of these areas, financials, materials, these areas have been significantly punished. Banks are down 30 and 40% relative to the S&P 500. Material stocks such as FMC or Sealed Air, Bubble Wrap, these companies are down 30 and 40% year to date. They already have earnings recessions priced in.